Michelle, given that we're talking about private credit today, and specifically the senior secured floating rate loan element of private credit, the most important risk for investors is that of credit risk. What can you tell us about company fundamentals today, especially in the lower middle market?
Despite the high rate environment and overall economic uncertainty over the last couple of years, private credit, and more specifically, sponsor-backed middle market company fundamentals have remained stable, proving to be a resilient asset class. More conservative capital structures in the middle market and guidance provided by private equity ownership have combined to provide borrowers with flexibility to weather or adapt to inflationary factors over the last 24 months, despite the higher interest rate environment. At the same time, the higher rate environment is a great opportunity for investors. The outlook for the asset class remains positive. We continue to believe that the combination of these factors will prove to be a good investment vintage.
Now that we've covered company fundamentals, let's turn to the supply side. Michelle, what does 2024 deal flow look like for the market, and especially for the lower middle market where First Eagle is most active?
What we've seen year to date in the broadly syndicated and upper middle market was that M&A volumes did not return to normalized levels. Instead, too much demand and too little supply in the market caused spread compression, which instead drove refinancing activities and, to a lesser extent, dividend recapitalization volume in the first half of the year. First Eagle's direct lending business participates in the U.S. private credit market, investing in sponsor-backed first lien senior secured loans in the U.S. to lower middle market companies. So businesses that have generally $5 to $50 million of EBITDA, historically averaging about $20 to $25 million. We focus on underwriting of high free cash flow, non-cyclical businesses that are more insulated from macroeconomic and geopolitical risk factors. So in contrast to the broadly syndicated and upper middle markets, the lower end of the middle market saw refinancing activities, but more importantly, experienced a resurgence in LBO activity driven by the sale of businesses to first-time private equity ownership. LBO activity in the lower middle market, buoyed by unique deal flow, is expected to continue through the end of 2024.
What trends are we seeing in the direct lending market today, and how is First Eagle participating in these?
In a post-global financial crisis world, private credit markets have grown over the years through their ability to exploit or fill gaps left in the market as the banking market has retrenched with increased regulation. In 2024, the specific asset financing market emerged in the private credit market, taking the form of either asset-backed or asset-based finance. At First Eagle, we believe the best place to play in this world of specific asset financing is in asset-based financing. It's highly structured, formula-based lending against the liquidation value of companies' primary assets. It's not traditional bank working capital financing, but instead the financing of assets that are typically not lent on by banks or advancing further into working capital assets. This type of financing is frequently used by asset-rich companies that are seeking liquidity while going through a strategic transition. As a result, these facilities tend to be shorter duration as the capital is transitional and expensive.
Okay, Michelle, let's turn to the crystal ball. What are your expectations for this market in 2025 and beyond?
The M&A market, driven by sponsor-to-sponsor M&A activity, is poised to make a recovery in 2025 for a number of different factors. First, borrowers are now a number of years away from COVID and the impact that COVID might have had on the performance of businesses. So generally speaking, businesses are in a better position to be bought or sold. Second, we've experienced 12 to 24 months of economic uncertainty that now points to not ending in a recession. Finally, interest rates are expected to start to decline in the near term as soon as Q4 of 2024. All of these factors are positive indications or have positive influence on deal-making activity. You then couple this with, first, the need for private equity to return capital to their investors. The length of private equity hold periods have extended as a result of first COVID and then the current interest and economic environment. So investors in the private equity space are waiting for M&A activity to come back and return capital to them. At the same time, both private equity and private credit markets have historical levels of dry powder waiting for deployment. So given stable fundamentals, as the cost of capital eases, M&A activity should open up, driving sponsor-to-sponsor M&A activity.
Michelle, thank you so much for your time and your insights on the private credit market today.